In our Intro to Investing unit, we talked a little bit about stocks, mainly just what a stock is versus other types of investments, its volatility, and its growth prospects for long-term investors. In this unit, we're going to dive into specific types of stock, and we will eventually actually get online and invest virtual dollars in the real stock market. The nearly 50 million people in the United States who own stocks are called stockholders or shareholders. And you can make money off of stock in a couple of different ways. Remember, when you own stock, you're owning a percentage of a company's or corporation's assets. The two ways you can earn money off of this are dividends, in which corporations pay a percentage or a dollar amount back to stockholders for retaining those stocks for a set period of time. Usually this happens about every quarter. Or a capital gain, which is just when the price of the stock increases over time, and I'm able to sell that stock for a profit. Common stock is the most common, imagine that, type of stock that is bought and sold on the stock market. It can pay a variable dividend, which means that dividend changes, and it gives the stockholder voting rights. Because remember, as a stockholder, I am a partial owner of that corporation, even if it is a 0.00000000001% owner. If you ever see the word proxy, that would basically just mean you give your voting rights to somebody else. An example of that could be if I own a few stocks in Google and I qualify for voting rights, I could transfer those voting rights to someone else in my place. Preferred stock pays a fixed dividend, so each quarter you're guaranteed a certain rate of return. Remember, that dividend is just a percentage of the company's profits. There are no voting rights for preferred stock, however. It's less risky because you're more likely to get a set amount of dividend paid back to you, but you could still lose value on the stock if its value declines. Some types of stocks we'll talk about, and these will coincide with those that we look at on the Investopedia videos, are income, growth, emerging, blue chip, defensive, and cyclical. We will be diversifying our portfolio to include types of stock from each of these categories. Income stocks are those that have a history of paying high dividends. An easy way to think about dividends is it's just a bonus that corporations pay back to stockholders to basically encourage them to hold on to those shares of stock. The more successful a corporation is, the more likely they might be to pay dividends. Growth stocks are those who really look into the stockholder to reinvest their profits back into the business to purchase additional stock. Emerging stocks are going to be younger types of corporations with not quite as long of a track record of success or of even being in business. Blue chip stocks are those of large, well-established corporations with a long-standing record of profitability. Non-cyclical means that a defensive stock remains stable regardless of what's happening with the economy. And some consumer staples that you looked at on the Investopedia videos discuss defensive stocks. Cyclical stocks are those that do well during economic growth, but may struggle during economic decline. So when we look at corporations like this, I know Airfare was discussed as a cyclical stock, because as the economy is booming, people have more money to spend at their discretion. But during economic decline, you think about what types of goods or services people choose not to spend their money on. Those would be cyclical stocks. There's the par value, which would be when a corporation decides to go public. That means they are now issuing stock. The assigned dollar amount they give to each share of stock when they go public is their par value. And the market value represents what you or I would pay for any share of stock that is currently being bought and sold in the marketplace. When we get online to MarketWatch, every value that we see will represent a stock's market value. So what factors play into the price of a stock? It could be the history of the company or how it's currently functioning, interest rates in the economy, the market or the economy, and its estimated earnings per share. What we'll look at primarily is going to be what's going on with the economy or the industry in which a corporation is a part of, and how that coincides with its stock price. So how do you earn money on stocks? And your capital gain represents what you would earn on a share of stock when you sell it. So if I were to buy a share of stock for $10, and then in 6 months I sell it for $15, my capital gain would be $5 per share. It's also worth noting, like we discussed in our last unit, that you can lose money on stocks as well. If I purchased a share of stock for $10 and then had to sell it a year later for $8, then I have lost $2 per share. So you can either profit or lose money on a stock. There are also fees that you might pay for trading stocks. You see the word commission, that basically just means a fee that you are paying to a broker every time you buy and sell a stock. When I set up our simulation on MarketWatch, we will pay a commission for every time we trade a stock. To trade a stock means to buy or sell. When we get on to online stock indexes, we might take a look at the NASDAQ or the Dow Jones Industrial Average. These are just listings of several corporations that are trading stocks. When we get online and look at MarketWatch, that is going to be a form of a securities exchange, which is basically just the marketplace in which brokers or individuals can buy and sell securities such as stocks. An over-the-counter market is one that is built up through different brokerages, and individuals like you or I do not have access to that. So it's just different groups of brokers who are trading stocks that are not offered on a securities exchange or on a stock index. Two big terms that you're going to see, not just in class, but pretty much in the news and finance for the rest of your life, are going to be these two terms: a bull and a bear market. In a bull market, that is a general feeling of optimism among stocks, and so you'll have rising stock prices, typically associated with economic growth. In a bear market, you'll witness falling stock prices and a pessimism in the stock market. That is going to be more often in economic decline or recessions. So bull market is good, prices up, investors very actively trading stocks and prices rise. And in a bear market, lots of folks getting out of the stock market for fear of economic decline. We're going to touch on some of these very quickly, and you might see them show up on a vocab or on an assessment, but really it's just to get the basic principle or basic concept behind the term. Buying on margin and using leverage essentially just means that you are borrowing money to purchase stock. So when you're buying on leverage, it's almost like taking out a loan to purchase additional shares of stock, at which you have to pay back that cash or that money before you're able to sell the stock at a later date. So buying on margin or using leverage is the borrowing of money to buy stock. When you are short selling a stock, you are actually borrowing stock from a broker and immediately selling it. And what you're hoping for is that the price of that stock will drop, and then you can buy it back at a lowered price. And then you get to return that stock back to the broker and keep any profits from that price difference. It's very high risk, It can be very profitable, but what you're essentially betting on is that you will be able to buy back a share of stock at a much lower price and then keep any profits from that after you return the stock back to a broker. So you are definitely taking a risk and leveraging uncertainty that the price of a stock is going to drop from the point at which you sell it. We are primarily going to be using the buy and hold and dollar cost averaging techniques as we buy stock, but we will talk about dividend reinvestments as well. Buying and holding is more of a long-term strategy that we discussed in our last unit. And for many of you in this simulation that we're going to take on, this might be the strategy you choose. Basically, you are loading up on shares of stock from different corporations, and regardless of what that price does, you're making the decision that you're going to hold on to it for months or years, essentially just betting that the price will go up over time. So it's generally going to be more low risk, and it's something that a lot of people engage in for long-term investing. In addition to the capital gains that you would eventually earn should you choose to sell the stock for a profit, when you retain shares of stock, companies can continue to pay you dividends so long as you retain shares of stock in that corporation. When a stock split happens, and this has happened with companies like Google, what they are doing is they are doubling the amount of outstanding shares in a corporation. Outstanding shares basically just means the amount of shares owned or purchased by stockholders. So they are doubling the amount of shares that can be bought and sold, and in turn, the price of that stock lowers. It allows a company to take on additional investors at a lower price. Typically, the shares of stock would rise over time because that company has a track record of being successful. In our simulation, you may choose to use a dollar cost averaging technique. What this would mean is perhaps every week or every few days, you are purchasing a set dollar amount of shares in a specific company. So perhaps you make the decision of spending $500 every 2 days in a specific company, or $1,000 every week. The amount of shares that you're purchasing would change because the price determines how many shares you can purchase with that dollar amount. But you've just decided that you're going to invest X amount of dollars at a regular time period in a company. Direct investment would include buying stocks directly from a corporation. Unfortunately, we're not able to do this with the MarketWatch simulation, but if you were able to, you could avoid brokerage fees since you are basically getting the stock directly from the corporation themselves. Companies pay dividends with the hope that you will actually reinvest that dividend or that dollar amount that they pay back to you right back into the company. So you're paid a dividend for holding on to stock for a period of time. Companies will pay you a dividend as an incentive to not only hold on to stock in that corporation, but to purchase additional stock with those dividends. And in doing so, you could avoid brokerage fees or taxes when you reinvest your cash dividends back into additional shares of stock. When we get online, we'll likely be looking at NASDAQ.com, which is a stock index, and also MarketWatch. And the stock chart can be very overwhelming, as you can see. A lot of numbers, a lot of values, a lot of calculations go into this. What we'll do in another activity is we will just look at a stock listing and we'll explain what these numbers mean to give you a quick picture as to what the stock has done over the last 30 days or a year. We can see its high and low price, how many shares of stock have been sold on a daily basis, its highest point, its lowest point, and its overall volume. So when we get online, this will become much more simplified because instead of just listening to a presentation about it, you will actually be seeing the market in action in real time. You'll see stocks being bought and sold, the price is changing, and you'll be able to track and monitor what's going on with your stock in a real-time format. This stuff is a lot of fun to do in practice. I know it's a little dry or might seem overwhelming from just a terms and concept standpoint, but I think you guys will really enjoy learning about stocks as we get online and actually play around with the stock market.